OPEC Plus is doing some work to rebalance the market in the first quarter, and you know, our base case is they'll be successful in doing that. The pressure increases for them to roll these cuts forward through the remainder of the year. Actually, we forecast around 1 million barrel a day surplus for the second quarter, and around an overall surplus of about 0.6 million barrels a day through the whole of 2024. So, you know, these cuts do need to be maintained to balance the market through the course of next year in our kind of base case global growth environment.
In the base case, what is the relationship of Saudi Arabia to oil-producing Russia and Iran?
Sure. Well, obviously there's a lot of complex factors going on with the political relationships between these countries. Overall, Saudi's taken the brunt of the cuts so far. And you know, Russia is contributing, and we expect them to continue to do so. They've been pretty forthright in what they want to do and in their expectations of countries meeting their quotas through the first quarter. And overall, I think that these, you know, when you look at the trade-off of the OPEC Plus countries, they essentially maintain the existing cuts, have some incremental compliance, and they can balance this market and keep this price at $70 to $80 if they work together. The alternative is obviously substantial spare capacity gets ramped up into, and prices could be down 30, 40, you know, even 50% if all of that spare capacity comes back online. So I think the alternative is just so painful that it's most likely you get this kind of 500,000 barrel a day cut through the course of next year at the right price. So,
well, hold on a second.
$70 to $80 is the right kind of price levels.
I want to develop that a little bit, Max, because you're talking about a potential 50% price cut. That could be a $40 handle on Brent crude, even $35 on WTI. And this comes, as we heard from Paul Sankey last week, there is this risk that as the U.S. ramps up production and as Saudi Arabia loses market share to the U.S., they'll flood the market. They'll just say, look, you guys are going to do this, let's go. And put all the barrels out there and get prices low enough that people start cutting production. What holds them back from doing that?
Well, I think obviously that kind of price decline will hurt everybody's profits and revenues. I think the stick or the stick that Saudi has is quite effective in the sense that they have the ability to raise production by 20% themselves. So they could offset, for example, on paper, a 20% decline in price with a big increase in their own production. Not many other, frankly, very few other OPEC Plus countries have the ability to do that. So in the worst case scenario, it's potentially least painful for Saudi Arabia and more painful for everybody else. So I do think that dynamic makes the stick quite effective. Obviously, if there was a hard landing on the demand side, if non-OPEC supply continued to grow extremely strongly, and on that note, we do have a material slowdown sequentially in US growth in our forecast for the next 12 months. Most of the growth that we have is actually OPEC Plus bringing back some barrels and or ramping up over the next 12 months. So if you take that out of the market, if these cuts were extended, you're actually running a deficit in the first quarter if the quotas are met as well, and overall if broadly the quotas are met, because we are assuming some slippage to get our balanced small, 100,000 barrel a day surplus in the first quarter. So it does appear that it's within OPEC Plus's grasp to hold the market together in the baseline. But yeah, look, a hard landing on the demand side, big surprises on the upside on supply, less disruptions than normal. Perhaps OPEC might break, but look, I think you have to get into a pretty dark global growth environment to even think about that.
Which raises this question, are we in a narrow range? You said, there could potentially be some sort of significant downside should production come back online, but you see that as improbable. So are we in a pretty narrow range after a lot of really massive swings over the past couple of years?
Yeah, I mean, certainly we think so. And positioning is extremely low now. The spreads have collapsed, and yet the price is being supported here. It's found some base here, we think around $75. If anything, a base case is we bounce back over the next month or two. Prices stabilize a little bit here. We think China's going to roll out a significant easing package, significant as in to stabilize the ship, not significant as in a 10% easing as a share of GDP, but significant enough that the market thinks that China will be fine next year, be able to achieve 4.5–5% GDP growth. There's been some big builds lately that we expect to stop, essentially. We expect a reduction in the builds in inventory that we've seen over the last 3 weeks over the next couple of months. So we are expecting a stabilization in prices.